Good morning. You got me again, for those of you who were in the room last time. I'm Robert Montgomery, and I'm very pleased to host this session on startups. And it'll be and you have to change the screen here, please. This says the wrong session. We would be imposters if we talked about that. This is all about startups, and I can already feel the energy in the room. How many people in the room here are startups? A lot, kind of more than half. Some are like, maybe I'm a startup, maybe I'm not. Yeah. But this is where the excitement and the energy is, and I'm a huge, huge fan of emerging companies and exploring and unpacking how to make them successful. And we have an amazing group of people who are going to tell us just that. So before we start the session, I'm going to ask all of our panelists to tell us who they are and introduce themselves, and then we can jump right into our subject at hand.
All right. Hello, everyone. My name is Fabíola Jaeger. I am the co-founder and CEO of Caleta Gaming. Caleta Gaming is a game provider based on Brazil. We are focused on Latin market, and here we are.
Hi, everyone. My name is Karolina Pelc. I'm the founder and CEO of BeyondPlay. BeyondPlay is a technology startup building multiplayer technology for operators so that they can provide their players with multiplayer experience on traditional single-player slots.
Hi, I'm Evert. I'm a portfolio manager with Yolo Investments. So my job effectively is to do everything I can to help our gaming portfolio companies grow. Very brief intro on the fund itself as well. So today we're 30 investments and about 200 million of assets under management.
Hi, my name is Martina Åkerlund. I'm the CEO of Triggy. Triggy, we build betting engagement products. We're working with affiliates, media companies, operators, and others. We have a white label app, a live score app that you can release in Google Play and App Store as a marketing tool and drive engagement and retention. And we also have a smart banner, a widget that you can integrate into your website that automatically read the content of the article and always present relevant odds connected to that one. And we're based in Stockholm and we're working global.
That's awesome. Great founders and some money. This is a perfect session. Fabíola, let's start off with you. What are some of the different ways that emerging companies should be thinking about raising capital?
So yeah, we are Caleta. We are part of Yolo. Yolo invested in our business 4 years ago, and for us, at that stage, we had different options to get investors, etc. But the reason why we choose Yolo, I would say, is there was a fit between us. Of course, the startup on early stage, you can get money in different ways. You can even get a loan with the bank. You can get with someone from your family, etc. But you need to have in mind why you are looking for an investor. What else besides money the investor can bring and assist on your business?
And what are some of those things?
In my view, the smart money is very, very important. And what I mean by smart money is all the network of contacts that the investor can bring, the ecosystem that the investor is inserted. Today at a Yolo investment, Evert can talk more about it, but there are more than 50 companies already. So it's very good. We are very well connected and we can exchange experience within the companies. The know-how the investor has about the market, about the product, about the business model is something that really matters when you are in an early stage.
Very good. Any other comments on that subject? How should companies be thinking about raising capital right now?
I can maybe comment on what we thought when we first secured investment, and there were some of the points that were mentioned here, but for me, being a first-time founder and very new to the journey, the important thing was to have a friendly and trusted investor as well. I wanted someone that is going to share the passion and is going to be able to spend some time mentoring me on the journey as well. We've secured investment last year, and our lead investor was LeoVegas Ventures, which is a subsidiary of LeoVegas Group. And it was also smart money for us, particularly on the aspect of providing product market fit. We're building technology that is hugely innovative, but also hugely experimental. It's yet to be seen whether this is going to take off with players. So it was important for us to secure operator partner that is 100% going to launch the technology, but not only that, but they're going to put execution resources behind it to make sure that we get the best possible chance of succeeding. And LeoVegas has proven track of innovating within the space of product development in gaming, so we thought they were the perfect beta launch partner for us.
I'll add on this. So from Yolo perspective, we always aim to be strategic investors, to bring something else besides money. That can be different things, just strategic advice, maybe even operational support with legal or accounting, or just adding the founder to the correct WhatsApp group at the right time, like more often than not, it's that. But the thing is, 92% of all VCs in Europe say the same thing, that they're strategic investors, but it's not actually that easy, because 65% of founders say that they did not get the help that they were looking for from the investor. So there seems to be some kind of gap in the market, kind of. For us,
that doesn't surprise me, though. Does that surprise you? Whether you're an investor or an operating company, it's we will add strategic value, and then when close happens, shit happens and people move on, right?
Yeah. So I think we are in a bit of a different position, unique position, because we actually come from a very long, strong operating backgrounds. We've been through the same journey. We have our own B2C brands. We have our own distribution network. So I think, especially in the gaming ecosystem, we're a bit closer to the startups as opposed to, like a, let's say, traditional VC.
Yeah, I can see that.
And just to comment on that as well, it's I think that's why it's so important to really be in line with the investors that you go for. And being a startup, you're just super happy to get some extra support because life is tough building a company. So having a strategic investor that really helps you and guides you and supports you, and of course that creates a win-win situation. If the investor make the company more profitable, it of course it's good both for the company and the investor.
Yeah, no, that's a great point. And raising capital is hard. Let's take a step back. Evert, maybe you could share a little bit of data from your perspective on the state of the market, which I think will help set the stage for the ensuing discussion.
Sure. So the market today is, let's say, challenging. Whether we like it or not, there's crossover from the real economy and like the public markets as well, that are both facing headwinds, like S&P is down 20%, gaming stocks even more than that. So what does that mean for VC? The funding is down. In Q2, the year-on-year decrease in venture funding globally was 30%. And the funds themselves have gotten much more picky when it comes to new investments. But I think there is an important point here that the best companies, or what are perceived to be the best companies at least, they still easily get funded today, and at decent valuations as well. And that's a lot of funds were raised last year when times were better, and the funds still have dry powder available, so there is liquidity in the market. And because of the fact that the funds are picky, there's also an added element of competition. Like if there's a deal, everybody perceives, okay, that's a higher likelihood of success. We need to get in on this one. So this keeps up the valuations, at least in the very top, like the 95th percentile type of deals.
So maybe to follow on to the theme, so what are some valuation or deal terms inputs that you can provide us?
I think it depends a bit on the stage as well, right? So we invest in C to Series A, and the earlier you are, the more the valuation still depends on like business-specific factors rather than what's going on in this magical market. But I think from a like early stage founder perspective, these are some of the things you really can't control. You can't do anything about it, right? So I would just, my view is control the controllables, grow the business. Like if your revenue multiple was 6 and now is 4, I mean, if you double your revenue, your valuation has still increased, right? So, yeah.
But let's unpack that a bit, because we have half the room, I think, were entrepreneurs or people in emerging companies. So, and a biggest challenge an entrepreneur has is, what is my company worth? How much money do I need? And what valuation should I ascribe? Have I invested and put skin in the game myself? What are the comparable valuations that are out there that I can base my own valuation on? Sometimes it's a finger in the air. It's a very difficult process. So Evert, maybe you can elaborate on how you go through that process, and love to have some of our other panelists comment on their own experience, because you all went through that. Am I worth 1 million or 10 million? I don't know. Let's figure it out. So that's a really important thing, because everyone goes through that that's in an emerging company.
Okay, so personally, I like multiples the best. Well, of course, if you have like seed stage company, maybe pre-revenue, what you're going to multiply, right? So then it's like the technology, maybe it's the like future potential or the market size, like addressable market size. But I think multiples are the most like what we can actually discuss here. So if you look at something like suppliers, I think there has been quite high profile deals like Relax, Big Time Gaming, No Limit City, where the EBITDA multiple has been like between 10 to 15. That also depends on how do you weigh the earnout part, which...
Forward EBITDA or last 12 months?
Last 12 months.
Okay.
So what I would do as a baseline today probably is adjust this multiple, what has actually happened in the public markets as a baseline, and then all the other stuff that comes in, like, I don't know, revenue growth or EBITDA margins or licenses, and it's as much art as science, I think. It's
Yeah. Comments from the others?
I think worth to notice that I don't think that the multiples that you're currently seeing in the market are relevant to everyone. I think it very much depends on what you envisage as your exit strategy as well, because some of the multiples are driven to a great extent by gray markets, which if you're focusing on launching operation in regulated markets, they're not going to be that relevant to you and to the investors that you want to bring on board. I think it's easy to get cocky when you're seeing these kind of multiples in the market and think like, why is not my company going to be worth that much? At the same time, the market is tough, and we're hearing about all these sort of macro trends where funds are being a bit more hesitant to invest and a bit more careful, more selective. So it's a thin balance between not getting too weak in the perception of your own company and what it could be worth versus going purely by what others are worth. So I think the safest way is to really be able to back it up with numbers, with detailed projections as much as you can. Because for us, for example, we are still pre-product. We are opening our next fundraising round, and we have to go around the potential of the team, the potential of the product, how it addresses the market trends rather than revenues. And that's where it sometimes is difficult to value what is my team worth, what is me as a founder, how much of the value of the company comes from the connections or the experience that we bring to the table. So I think it's a balancing thing, but certainly I wouldn't recommend to just look at the valuations that are happening in the market, because that would be quite arrogant in my view.
Fabíola, Martina, any comments on valuation?
Yeah, that's of course it's extremely difficult, and just as you're saying, the market also goes up and down, and what you see is like valuations are being pushed, but of course it's also like in a dialogue with different investors, you learn as a startup, you get the feedback, either they buy the valuation or hopefully we come to a discussion instead. So I think also that's always like balancing on a thin line, just as Karolina is saying, it's easy to be cocky, and maybe that's not the best way of doing it, but I think it's always good with a dialogue around it.
Plus, if you pitch your company at too high a valuation, you go to the investor, you've blown your brains out, because it's hard to go back with your dignity at a lower valuation.
Yes, it is.
it then shows you're shooting in the dark, because if you're
Right.
confident with the evaluation, you can back it up, then there's a conversation of trying not to go off too high from. But if you go way high and you can't back it up, then you're clearly trying to take advantage.
Yep.
That's a very fair point. I've seen this a couple of times where the valuation is X and we say we think you're worth half X. If the founder says yes, then it's a bit of a red flag. Like, what?
Yeah, I would say also valuation is very well connected with innovation. As a game provider, as you know, there's a lot of products, a lot of content on the market. And if you have to do something innovative, some different products, something that will help you with the valuation, increase the valuation, because you have to do something different
Yeah.
to stand out.
So on that subject, are there any comments on deal terms, structures? Are people, are you seeing, what have you pitched to your investors? How are your companies funded? Is it, are they seed A, pure common equity? Is it prefs? Have you used safes? Maybe we can have some comments on how you've put your own financial structure together and why.
Well, I can only say I don't have that much experience in this. I've only done one round and I'm starting another one. So I'm learning at the moment about convertible loans as one of the mechanisms. But at the moment, our investors were invested straight up into the company for equity. And I think this is our preferred way to go forward. It's about, when it comes to structure, it's more about trying to figure out the right combination of people or funds that complement each other in different areas. And the one thing I wanted to mention is I think it's exciting with our industry, and I think it would be in trouble as startups if we didn't have that ecosystem of industry-specific VCs and industry-specific investors, because it's hard enough to explain to someone that has worked in the industry on an operator side what is a multiplayer slot and why this is going to be the next big thing. Try to explain it to someone who has never seen a slot machine, online slot machine, or doesn't understand the intricacies of this industry or trends. So we, for example, have never even ventured outside of the industry to try to pitch it, because we just would be met with complete misunderstanding or lack of understanding.
Fair enough. Evert, when you look at structures, do you ask for prefs? Do you do convertibles with warrants? What's the sort of preferred approach you have to merging companies as an investor?
In the stage we're investing, it comes mostly down to whether it's a convertible note or just straight up equity. Personally, I like equity because it's just straightforward, but I can certainly see the benefits of doing convertible notes at this stage. Like the previous topic we discussed, it's hard to set the valuation. So with convertible note, you kind of can push that along. Like
right.
We don't have to agree on a valuation right now. We agree on a reasonable cap, a reasonable discount, and it probably operationally saves some time, effort, and money as well. Like you don't have to actually issue the shares. It may be cheaper to do a convertible note. So I think that's a perfectly valid option.
It's also a solution to valuation if you're not exactly sure what your company is worth.
And it's also a solution to some regulatory challenges, right? So
right.
I don't know if that's entirely true, but I did hear a couple of opinions that in the US, there's, especially when you target high net worth individuals that really don't want to go through the regulatory headaches of having to submit their bank statements, source of funds documentation, all that. There's ways of bringing investors on without voting rights, which streamline the process to a great extent for them.
So generally, in most North American jurisdictions, there's a 5% rule, and if investors have more than that, then they do structure it as debt, and plus they may have some warrants, but that gives them no level of control that would make a regulatory party uncomfortable. So that's correct. Sometimes you have to structure around that. However, they're looking at it in many ways as an equity return proposition. Yeah. So let me ask all of you a question. I think this is also on the mind of anyone in an emerging company, is exit. Because everybody, those of you who have taken capital in from private investors or from venture capital funds, and by the way, it's always been odd to me, I don't know about you, including companies I've invested in, where there's a celebration around capital in. And I actually think the celebration should be around capital out, because investors are in this for a return. And so are you. The exit is, maybe it's building your dream, of course, is a key proposition, and being able to, realize your vision and your dream. But as soon as you take third party's money, you know one thing for sure, they want it back. So you need to start thinking about exits, perhaps sooner than you'd like to as you're moving through your strategic vision. How do you think about exit, and does it figure into the vernacular for you and your team?
Yeah, at Caleta we are growing, we are generating some profits already, but we are reinvesting these profits so we can improve our products, our technology, etc. So there's no rush at the moment for making an exit, but for sure it's something that eventually will happen.
Yeah. I would disagree with you slightly on non-celebrating the capital in, because I think it's a tremendous achievement for a startup in the current environment to be able to get capital in.
Oh, I'm referring to the investor.
Yeah, of course. But in terms of exit, of course, I'm on the opinion that it's way too early to be thinking about exit right now for startup. And then you also have to consider that these days, the exit quite often come with very restrictive period of earnout, where you essentially have sort of exited with some money, but then you have another 4 or 5 years under immense pressure where you're not managing your company anymore and things are out of your hands. So personally, I feel like not all these exits come with such great benefits immediately. Of course, you've got eyes on the prize after that period of earnout, but I'm really enjoying being able to steer the ship right now and create my own, culture, strategy, and I would like this to last for quite some time before I'm, part of big corporate mechanism that tells me what to do again.
Right. Martina?
Well, I'm thinking just as you're saying, this is a discussion that you're normally forced into kind of early, because in the dialogue with the investors, it's important to set the same expectations. If you want to have double the money in 6 months, or if you want 5 years, 500%, or the expectations and the investment strategies varies. So this is discussion that you need to have with the investor. But I think as founders and the team so forth, just as Karolina is saying, you have so much fun building the company, and that's your main focus. But I also think that's the key focus, building a successful, profitable company as you ever can. That will always put you in the best position. Have a dialogue with the investors so you set the same expectations.
Yes, indeed, alignment. So in the annals of alignment, Evert, what's the average hold you look for an investment with respect to companies that you've gone into, and how do you propose to your CEOs that they think about, or management teams, that they think about exit?
So I think we're a bit different compared to other VCs in that regard. It's one of our principles. We don't want to rush anything. So as Martina said as well, it's about building. We want to be there, support the company in the growth process, which can be, I think the traditional hold period is 5 to 7 years or something. But if it's more, it's fine in that sense. We're in it for the long term. We're not here to make short-term games. It's not trading. So it's not, yes, the exit scenario planning and analysis, that's all part of it. But for us, it's more at the decision-making process at the beginning. But day to day, if I call Martina or Fabíola, we're going to discuss product roadmaps, not exits.
Yeah, great.
Very good. So what keeps you up at night? One of the key things that a startup entrepreneur worries about is cash. How do I make sure I have cash in the bank to see me through my period of time until I either can raise more money at a higher valuation or I have cash flow? You mentioned, Fabíola, that you have cash flow, which puts you in a different position than most startups who are using metrics other than cash flows. Maybe you can elaborate on that. What keeps you up at night, and how do you address that from a leadership position?
We had cash flow now, but in the past when we got investment, we didn't. So
yeah.
I think it's very important when you're looking for an investment, you have in mind, you prepare some business plan. Of course, the investor will ask for that as well. But how you gonna spend the money in the way that you can spend it properly to grow healthily your business, and includes also the hiring, the products, the technology. Is quite difficult at the moment to find developers, as we all know. So sometimes you face some challenges, and then you probably on my business plan I set some money for this, but then you have to change and go in a different way. So having a good financial plan is something very important.
What keeps you up at night, Karolina?
For me, it's licensing and regulation, for sure. And that is very directly relevant to investment, because it's quite hard to determine timelines of go live, because there really isn't any guidance by you can go with how long it's going to take you to get your UK license, especially when you're a product that falls a little bit in between and there is no dialogue with the regulator whatsoever. There are things like change of control, new money coming in, investors changing, and that requires either a substantial delay to your licensing process or sometimes even resubmission. So I worry about, trying to piece this together, securing new investment without impacting my pending license. At the same time, should we already submit New Jersey, or should we wait until we complete the round, because maybe people are going to come in, and so that for sure keeps me at night. And then, as you said, I mean, it's very hard to secure resources at the moment in the industry, especially if you're trying to build on the latest technology stack. You're competing for people with the likes of Uber, Google, and some really high tech giants. So again, it's you can promise to your investors that you're going to deliver the product by X time, but then if the license and the inability to scale the team with experienced talent stands in a way, it's a little bit out of your hands. So that for sure stresses me out.
Martina?
Well, for sure, like investment, having money to pay the salaries every month, that is important. But I'm thinking, like, in different phases, you have different kind of difficulties. As Karolina is mentioning now, that is like one part of the journey, and of course the team, to keep them happy and have them staying in the company. That's crucial, being a startup. And also, like, focusing on sales, and so you stick to the forecast and the roadmap that you have, like, promised the investors. So it's a combination of things, and sometimes I just wish for those days when it will be like an easy ride. But I think that when you're working with a startup, it's one of the things that you really enjoy is that there are always new questions. You just have to look at them, and maybe not so they don't keep you up at night, because then it gets tough in the long run. You have to, like, try to have some distance, and also try to believe in that you will manage and you will find a way.
That's a great point. And I often think about startups like the sailing analogy. If you're pulling on a line in sailing and it's not budging or moving, you're probably pulling on the wrong line. Yeah. So those are things that often come to mind as well. Those are some great resonant points. So I want to turn to everyone here. Would anyone like to make a comment or ask a question or pose some kind of statement with respect to what we've talked about here? I'd welcome that, and so would our panelists. Please. Well, in America, they'd be like, oh. So, okay, well, I just wanted to make sure I turned to everyone and had the opportunity to do so, because you never know what's going on in everyone's head and if they have something brewing that they wanted to raise. Oh, here we go. Oh, we got a mic. Sorry, I didn't know that.
Hi, my name is Mark. Can you hear me? Oh, brilliant. I was wondering if you take into account, like, market movements in the next year, 3 years, 5 years into your business plan.
Of course, we have to, especially when it comes to M&A activity. I mean, I'm already experienced this. My investors, Leo Vegas Group, that was just recently acquired by MGM. So I've learned firsthand that those things are happening and can impact on your business to a certain extent. So we are looking at what's happening. It does make a difference to who you talk to for your distribution. If there's sort of requests from different parties for exclusivity, you need to think about how that's going to impact if they were going to merge with someone else. And I think it's a constant, as I said before, piecing puzzles together to make sure they fit not just now, but also in 6 months, 12 months.
Okay. And for example, like the US is changing, for example, like consolidation in the next few years. Are these things that you mentioned, Robert, about what keeps you up awake at night? Is this something which like stresses you out? Like what you're building now, you can have a market which is like not very, but different in the next few years?
Well, absolutely. Like, I think we've been like extremely aware that really big things can like change the economical environment really quickly. Like when COVID hit and we're into sports betting and all sports were cancelled, that's like kind of tough. So it's so of course big things happen, and you cannot. You will try to always calculate on what will happen or what will affect the market going forward, but it's of course extremely difficult.
Thank you. Yeah, being an entrepreneur is very hard, and it's full of challenges, but the victories when you get them are very sweet. And I think we're all honored that all of you have come up, because it's not easy to come up and share these stories. And being an investor is very hard, because it's a portfolio and they don't all sing. And so I think we should all be very grateful to you all for coming and, you know, showing us yourselves and your thoughts and helping us along this journey. Thank you very much.
Thank you.
Thank you.